So RWC is an active fund management business founded in 2000. We manage money for pan-European investors across Europe, in Italy, Switzerland, Germany, and the United Kingdom, among others. We currently have 7 investment teams, and the common theme between all of them is that they are active fund managers. They're unconstrained by indices, and they aim to make long-term total returns for their investors. We have a spectrum of funds from deep value equity investing through to long-only convertible bonds and absolute return funds. Over recent years, we've seen the majority of our growth come from the UCITS part of our business, where we deal, where we see significant interest in investments from European institutional investors and the private banking and professional investor market. Well, I think if you go back 10 years to the start of open architecture in Europe, where private banks started to use many more third-party managers within their clients' portfolios, the area was dominated by asset managers attached to bank distributors, managing index plus products, so funds that would aim to outperform the MSCI Europe Equity Index or the Lehman Global Aggregate Bond Index by only 1 or 2%. And I think in the last 5 years, you've seen a seismic change from 2 aspects. One, you've seen the increase in use of ETFs and index products by investors who are looking to access beta for very low cost. And you've seen the rise of proper unconstrained active fund management and the use of those funds by institutions and private banks. And those would cover anything from unconstrained equity funds to absolute return funds. I think the second big change has been that you're seeing the open architecture of private banks increasingly look to add value to their investors by finding the best-in-class fund managers. They may not have the biggest brands, and they may not be the biggest funds. Quite often, in fact, the bigger funds are the ones that are too large to perform. And you see the rise of independent businesses that are running comprehensive UCITS products. I think particularly since the credit crisis of 2008 and the increase in flexibility allowed under the previous UCITS legislation, UCITS 3, you've seen both an increase of supply of absolute return funds as hedge fund managers look to enter the regulated funds market, but also the increase of demand from investors for funds that can provide a more conservative exposure to the equity asset class through long short, and funds that can provide diversification benefits away from government bonds and equities.
Actually, in general,
I think there is a generational change happening where the responsibility for paying for individuals' retirement is moving from the governments and the corporates to the individual. And I think with that comes changes. I think there is a huge increase in demand for the highest quality products and funds. And I think there's a huge increase in the professionalism of the industry. And I think with that comes a change in approach to portfolio construction. And funds that can provide more conservative exposure to some of the higher volatility asset classes, such as equities, we are definitely seeing an increasing trend for. One of the issues is that simply because a fund can have the flexibility to protect capital in falling equity markets. That doesn't mean that it necessarily will be able to do that. That ability is a function of the fund manager's experience and skill. Well, I think you definitely will continue to see the rise of or the growth of the fund management industry on a long-term view, simply because we as a community need to save for our retirement. And I think that the government and corporates are no longer going to be underpinning that. We're going to have to take responsibility for that ourselves. And I think that with that will come the need to take risk and to allocate money to fund managers who can grow the capital base of your pension fund. I think that there already is the appearance of a trend away from the very established large, probably bank-owned asset managers to independent businesses that have a single focus on asset management, and that's driven in large part by the increasing professionalism of the intermediation, where the private banks, the trustees of pension funds, the multi-managers see it as their responsibility to choose the best-in-class funds for their portfolios, and quite often those funds and those managers are sitting within the smaller independent fund management businesses.